Ntombenhle, we have the futures close out past us now, and it really looks like we're just going to drift towards the end of the year. The market has come off its worst levels after a pretty soggy start this morning.
Yes, yesterday futures closeout was well received, and I think a lot of people are now gone on leave. They're in holiday mode. Markets are lackluster at the moment. So going forward, I think we'll see maybe some window shopping next week, and we've got the United States GDP coming out next week. So maybe that will be the only thing that really moves the market. But yeah, just low volumes, thin trading, and also then just waiting for 4:30 when the United States opens.
And of course, in the United States this evening, we have what they call quadruple witching, which is their futures close out for the equities market, for the currency market, and also for the bond markets. Would you expect some action coming through at that stage?
Yeah, I think we were expecting a pickup in volumes towards the end of the day, especially just when the United States opens. The UK also had options expiry today, but nothing much really coming out of there. But yeah, so we're expecting a little bit of a pickup. But as I said, look, I mean, we're at the end of the year. Nothing much is really happening in terms of our markets, and it would just be reactionary stuff that we'll see in our markets later on today.
Now, we have seen a bit of a pickup in the resources stocks this afternoon. They're up by about 1/3%, and really bringing our market back up to that kind of break-even region. And gold price picking up a little bit, but still looking pretty lackluster, isn't it?
Yes, I think, what's happened with Greece and, all the smaller economies, what we've seen from there has really affected the dollar. And I think that's where we're seeing what's happening with commodities has been affected by what's happening with the dollar. We see the dollar strengthening quite a bit, and the euro is down, and commodities have pulled back quite a bit from their highs. I mean, Alicia earlier was talking about the oil price being now at about 73, but it's still way off high $79 that we saw earlier in October. But so we're hoping to see some kind of reversal towards the beginning of at the beginning of next year. But for now, I think commodities are just going to take the back seat, and we're not going to see much coming from there because of the risk aversion in the dollar.
Of course, we did have those worse than expected initial jobless claims out of the United States last night. You mentioned Greece, downgraded by Standard & Poor's yesterday. Fitch Ratings, of course, downgraded them last week, and now Moody's is expected to make its own move in the next week or so. So, as you say, risk aversion really still in the markets at this stage.
Absolutely. I mean, those jobless claims were I think 480,000 up from last time, and what we also saw was that the Philadelphia Fed business analysis or report came out, but that was ignored by the market. And then we also saw the leading indicators come out in the United States, also ignored by the market, really focusing more on those jobless numbers, and also the Citigroup story where there was lackluster or a lack of interest in the share issue, and therefore delaying the US government's sale of their interest in Citigroup. So those kind of things coming together to just really point a dismal picture or dismal close yesterday in the United States.
And of course, I should imagine at this stage of the year, investors really aren't willing to take positions when you are still getting bad news coming into the markets, and of course when volumes are thin, so it could drive volatility.
Yeah, you could potentially drive volatility, but you need players in the market for anybody to really benefit from that. But I think what, as I said earlier, we are at the end of the year. If anything that we're going to see would be maybe portfolio managers doing some window dressing and to boost their Q4 results. But it is expected. It's nothing new. This every year end we go through a more quiet period in the market.
And of course, this year has been a little more tumultuous than most years, so it has been quite a tense year for most traders, I'm sure. What would you expect when the market reopens in January again?
I think what this year has really showed us is, how the stock exchange really defied what the fundamentals were. I mean, we had some bad data coming out where the first part towards the first half towards maybe midway through the second half, the data was dismal, especially from the United States. Job numbers were not looking good, especially the retail sales data. It only picked up now in November. And so going forward next year, I do expect more players in the market to be a little bit more optimistic. I do expect that, because of the performance that the markets has shown, despite the fundamentals, that there'll be more funds coming into the market. That it's still going to spur itself despite the fundamentals. And I think maybe we'll see a recovery that's self-fulfilling rather than based on what economic fundamentals are telling us. So, and I think also the dollar and the United States have shown us that that, you know, they're not ready to be written off. I read an article earlier saying that, you know, the euro has gone down a little bit because you know, it's a failure to overtake the dollar. But you know, I think those are the things we should be looking at next year.